Before you think about investing, buying properties, or even paying off your HECS debt, you need to protect the one thing that pays for all of it, you, because you're the income generator. Most doctors don't think about financial advice until they're earning big bucks or buying a home or their investment property. But by then, you already missed the easiest wins and the cheapest protection.
You're the asset. You're the one who earns the income. You're the ATM. So you actually need to protect that. The most important thing to do is ensure that asset being yourself and your ability to earn an income from income protection.
In this episode, I'm joined by Roger Wheelahan, our in-house financial advisor with over 25 years of experience, and we're going to walk through what financial planning should actually look like for doctors from intern to retirement and beyond. This episode is all about giving you a full life cycle roadmap in plain English so you can make smarter, secure financial decisions at every stage of your career and life.
Structuring is pretty much one of the most important things of who owns what asset. So that's where the real value, I believe, is added. Plus the education you get around how these different structures work and the tax incentives and just different sort of rules and regulations around the different structures. So that's where it really starts to really show its value.
Here's what we'll cover: why your ability to earn is the first thing you need to ensure, and how most doctors are underprotected without realizing it. The common traps with super, income protection, trauma, and TPD, and how to avoid overpaying or being undercovered. Whether you're just starting out or already years into practice, this episode will help you avoid expensive mistakes and set up the foundation of real financial security. So for those that are viewing, this is the first episode in our 3-part series on what it means to have a financial advisor from intern to retirement. Now let's get into it. Hello, welcome back to another installment of the Investing for Doctors podcast. Today, we have a familiar face back with us. This is Roger from IFD Financial Planning, who's
Morning.
our in-house financial advisor.
That's correct.
Roger, for those that have not met you before, give us the 30-second intro.
Well, I've been a financial advisor for 25 years, in the industry for 27 or something, ran several practices and did the corporate world, but now running my own practice again for another 7 years. Now, built the practice with yourself and the rest of the team of the IFD group, and couldn't have made a better decision.
Awesome. Welcome. And we look forward to having a interesting discussion today. I think there is still a lot of sort of misconceptions about what a financial advisor actually can do, can't do, and where that engagement process should start. So I think in today's episode, we'll like to do a bit of maybe role playing, but maybe like talk about a hypothetical doctor from the start to the end of their career and even beyond.
Sure.
All right.
Yeah.
So we're gonna do a bit of a life cycle approach to these things. And so in this situation, we start off with our medical student who's going through medical school. They obviously thought, getting to medical school, doing medicine is a good investment for them and their future careers. Yeah. So, and off they go. And after a couple of years, they finish, they're qualified as a doctor, they got a degree behind their name, and they go into the workforce as an intern, which is the first year out.
Yep.
Now, at this stage, most interns, if they are on a Commonwealth supported place, they would have a sizable HECS debt, depending on whether they did an undergrad or postgrad study, and they, start off.
Well, they've got a discount now.
Oh yeah, they do get a discount.
20% discount now, yeah.
So that's good. But they start off on a reasonable income, and they get started working in the hospitals. Yeah. So at this stage, most people think, oh, you know what? I haven't got any money. I haven't got any assets to invest. But I think you would beg to disagree.
Oh, absolutely. Yeah. Absolutely. See, it has, in my 25 years of providing professional advice, I did hear that a lot from younger people, not necessarily when I started out with professionals such as doctors and what have you, but tradies and what have you. And, they'd say, oh, I don't have any assets and what have you. And I'd say, look in the mirror, you're the asset. So that, they were quite surprised by that, by saying, what do you mean I'm the asset? And I said, well, you're the one who earns the income. You're the ATM, as I like to always put it.
Yes.
So you actually need to protect that. So you would obviously insure your house. Absolutely. You'd insure your car. Absolutely. Well, what pays for those assets? Even you say you might not have an asset, you may have a mortgage, which is geared to the hilt, obviously. The bank owns it.
Yep.
But yes, you would insure that and your car and what have you, but you need to insure the ATM yourself as actually what is generating the income to pay for these things and for the insurance on those houses. So it's obviously the most important thing to do is insure that asset being yourself and your ability to earn an income from income protection.
Yep.
So, there is various types of income protection and what have you with, leading from your tradie right up to your
Professional
brain surgeon
Yeah.
to the high court judge or whatever you want to say. But you are the asset. So you need to, that lays the foundation in my opinion, and most of my colleagues' opinions of the financial advice process is ensuring your ability to continue to earn money. And if you can't, still be able to protect your family and still aspire to the quality of life that you're aim for.
Yeah. Yeah. So, I often see this where, a young doctor comes out and say, well, I'm single. I've got no real, liabilities apart from myself. But really you are also a liability if something happened to you and you can't really do anything about it.
Well, absolutely.
Yeah.
I mean, if you are a young single person and you do get a mortgage or even just a little bit of debt or anything, and you just say, you get hit by a bus, and we know what that means, you die. Your debts don't die with you. They will be passed on to your next of kin or your estate. Sorry, your estate, obviously, and the family has to make sure that those debts are paid.
Yeah.
So, you need to make sure that, you may think that you got no stress, no responsibilities, but if you've got some sort of debt, it's going to not die with you. It's going to pass on to your estate and someone's got to deal with it.
What about HECS debt? Does that pass on?
Yeah, it's all
Really?
debt. Yep.
Yeah.
Yep.
Okay. So who pays for that? I mean, does your
Well,
your
the estate's left with it,
Yeah.
and the beneficiary of the estate, or the executor of the estate has got to come up with the funds, and sometimes they're liable. That's why you got to be careful when you nominate an executor, or executor's got someone who's been asked to be an executor of an estate. You got to make sure that they've got all those sort of things covered, because it could come back to you and you be left holding the baby, so to speak.
So Roger, what about say I was a freshly minted intern, day one of the job, step off the curb wrong and got hit by a bus, and I've got $150,000 worth of HECS debt. What happens there? Does that pass on to my estate?
Well, luckily, no.
Oh,
So
good.
That's one of the few concessions the government will give you.
Yeah.
Because it's a uni debt, but any other sort of debt with assets and what have you, absolutely.
Yeah. So if I had a student loan that is not HECS related, that will pass on.
Oh yeah, because that would be from an institution, because generally HECS debt is government funded.
Yeah. Oh, so at least the government tries not to screw you when you're dead.
They do. Look, there are a lot of things that the government rules in place that are quite good, which is what we know a lot about, which we can help clients with. But I mean, I still whinge about the government. Who doesn't? But there are some good things and concessions out there.
Yeah.
If you just got to know about them and find out.
Yeah, especially recently, I think they've tried to reduce everyone's HECS debt by a little bit.
20%, yes.
Yeah.
Yes. Elbows sweetened the deal and helped him win the election by providing a 20% reduction in your debt, your HECS debt.
Yeah. I think that's obviously very welcome by a lot of people that still have
absolutely.
HECS debt.
And they lift the threshold too of when you've got to start paying with the level that you earn.
Yeah.
I think it's another 13,000 higher. I can't remember the actual figure, but it's about 8% higher before you have to pay.
And start to pay it back. Yeah. I guess that's the help with the affordability issues that young people are facing.
This is a sweetener. I mean, it sounds good. I mean, you can earn more money before you have to start paying it back, and you pay only 80% of it back.
Yeah.
That's a pretty good deal.
It's a great deal. I wish I had that when I was.
So we'll go out there and study more.
Make sure you invest in the right degree though.
Yeah, that's right.
All right. So obviously, the asset is the person. And that's why I said, you put your time, money, and effort into investing in a medical degree.
That's right. Yeah, you've invested into yourself, and you're protecting your ability to earn an income now and both into the future. So you got to protect that. And I just have this vision in my head. I just say think of yourself as an ATM, and if you had an ATM in your lounge room, would you insure it?
Yeah.
And of course, everyone said, well, of course. It's just like your car, your house. Of course you would.
Yeah. And so, I mean, I think most people coming out don't think with that mindset. Most young people don't think. They think they're invincible, they're
Absolutely.
they're infallible and unkillable at various points in their life.
Yeah.
And obviously once you start working, you get some superannuation, and there's that tiny little bits and pieces within your super, but often that's not enough to cover most things.
Yeah, there's nominal amounts, and it's usually industry fund. They have a system called, like, it's a unitized form of insurance where it's based on excuse me, your age, and they give you a nominal amount, and generally it's not much. But the funny thing is with that, as you get older, the units come down. So they remove your units as you get older, and a unit is a measure of cover. So one unit could be like $5,000 worth of death cover. So as you get older, they reduce it, but your premiums go up at the same time. As you're getting older, they reduce your cover, but your premiums go up. So people say, "Oh, I've got insurance in my industry fund." Well, yeah, you do. Well, you should, unless you've opted out. It's default, but you got to understand how these things work. It might seem straightforward, but there is a lot of complexities around it, and that's where we can just help people, just understand those basic few things. What I just explained there, unitize people to get that. It goes, it's based on your age, goes down, but the premium goes up because you're getting more risk because you're getting older.
Yeah.
You are more risk to the insurance company.
Yeah.
But with the retail insurances that we provide, and we've only spoke on income protection, it doesn't work like that. It's based on individual underwriting of that person. Yeah, it's based on your occupation, smoker, non-smoker, current scratches and dicky knees or anything like that, and totally assessed on you, how you are at this point in time, and it's priced accordingly to your age and what have you, and then it generally goes up with inflation. Your cover goes up with inflation, so does your premium. You can have to opt out of it, but that's where we can help keep control of it, because we can review it and reduce your cover if you need to reduce it. Because the theory is, obviously, the more debt that you have, the more debt that you have, the more cover you should have.
Yeah.
But as you reduce your debt, you should be able to reduce your cover. But see how that goes against the unitized model?
Yeah. It doesn't match.
No.
It doesn't match the risk and sort of your liabilities with your stages of life. Because usually people, when they first start out, you don't have that much liabilities until you get a house, investment properties. But at that stage, it could be going the other way. Yeah,
because that's exactly right. Because as you're getting a bit older, you're 25 or what have you, and then you get to your 35 or 30 and you go, oh, right, I can now afford to invest in investment property. Your liability's gone up. So you need more cover.
Yeah.
But at the same time, your cover's been going down because you're getting older.
Yeah.
So it's why it really, really pays to get some advice from an advisor on that, because there's multiple products out there for multiple life events, as what you're talking about earlier, different life events. So yeah, it's not as simple as it seems, but with the general insurance, which is what we call, your car, house, contents and what have you, that's thrown at your face every day on the television.
Yeah.
So you can make your own and pitch to you.
Yeah, and it's covered like for like, you can visualize what you're covering. Yeah. It's usually an item and there's a replacement value, and then that's.
And that's why we don't generally we don't deal in that. Well, generally speaking, advisors don't deal in that type of insurance, because, as I just said, you can make your own mind up, and it's they throw enough education at you anyway on TV and what have you, and competitiveness. But when it comes to life insurance, which covers, by the way, when we say life insurance and risk insurance, it's the same thing. It actually means life insurance means life, income protection, TPD, and trauma. So when we say life, it covers those four main aspects, types of cover, which I think we've spoken on these before. What they do,
we have, And when I talk about risk to a lot of doctors, I approach it from the 5D approach.
Right.
So I think the most obvious ones is death. As we said earlier, your liabilities may not stop at death, so
they don't die with you.
Yeah, you gotta keep an eye on that. Yep. So death, disability, divorce. Wish there was an insurance against that, but
there is. Don't get married,
or don't live with anyone, because you don't need to be married these days.
That's true.
And the other two, which is sort of more industry specific, is de-accreditation, which means get kicked out of the hospital or service you're working at, or deregistration, which means you get completely canned altogether, or you face the wrath of APRA and you get stuck in limbo for whatever.
So we're not
reason.
talking about retirement there, deregistering yourself as
Well, I mean, that's not a risk. That's a reward.
decision.
That's a reward
That's
at the end.
absolutely
I don't
right.
think you gotta.
Yeah, well, that's another conversation.
That's another conversation
that's
for a different episode.
Yes.
So I guess life insurance is the bit that covers death insurance is the one that covers death.
Yeah.
And then for disability, that's income protection, trauma, and TPD cover.
Yeah.
And you got to make sure those things are really.
Yeah, look, we have gone through this before of what they do provide. I mean, death, life, same. It's what it covers. One thing's got to happen.
Yeah.
You die. There's no black and white. You're either dead or you're not. But like you said, with the TPD, totally and permanently disabled. And there's a couple of different types of that. 2 types of that. One's called any occupation and own occupation. So what that simply means is any occupation, you have to be disabled totally disabled to a point, or permanently disabled to a point where you can't do anything. You are pretty much like a quadriplegic and can't do anything. That's any occupation. So you can't do anything. There are terms and conditions around that, but I'm just explaining this as basically as I can. But then there's own occupation, which is designed for specific professions, pretty much more for the medicos, like a surgeon or someone who's specific, a specialist in a particular field. And that says if you're TPD to a point where you can't do your own occupation. So if you're a surgeon and you damage your hands, you can't do that anymore. So you get paid out easier. But you could go and lecture, you could write a book or dictate a book or whatever, but still, because you can't do your own occupation as specifically of what, that's your occupation, and you get paid. And that's why there is that pretty much, you have to be pretty much highly skilled, high senior managerial position and or degree qualified to a point where it's very specific of what you do. That one task is the pivotal point. If you can't do that one task, then you get covered. So, it pays to look at that as well, because that doesn't cover death. So, you have to keep looking at, so you have to look at the different types properly. And trauma, as again, I've mentioned before in the past, that trauma is like a traumatic event, hence the name, and they developed that protection or type of cover many, many years ago when the old days when it was the husband at working and the wife at home looking after the kids, there really was no insurance for her except for life. So they came up with something called trauma insurance or critical illness insurance where, because that role of running the house and looking after the kids actually has a lot of value, which we now know it does. I mean,
we now are... I think more people are talking about it and admitting to it. I think there was always that value, but it wasn't discussed as if in a economic sense.
Wasn't valued.
Yeah,
but
it wasn't
now
discussed in dollar and cents or the economic.
Well, that's right.
sense.
So that was to cover the wife at that time, and that was to cover her job if she couldn't do it, so you could get a nanny in, someone to help, or a housekeeper, and all those types of things. So then it developed onto like, well, we should open it up and extend it to everyone. And the big one was first initially was the heart attack, cancer, stroke, right? So now that's what it covered. And then you're not necessarily TPD'd from those, especially with today's medical advancements. So, they extended out to like up to 65 different conditions, like, Parkinson's, MND.
I think fractures and...
fractures, but blood disorders, all those types of things, angioplasties, of course, heart attacks, and valve replacements. And there's more specific. So up to 65 different conditions. So again, that covers a lot more. So it costs you more. Because it costs more. Because it covers so much more, it costs more. The TPD covers a couple of things. It doesn't cost as much, and death covers one thing. So they get more expensive. And they're your 3 lump sums. So you can see they have their very distinctive roles. There looks like there is a bit of a overlap grey area, because trauma, you can say, well, a loss of independent living. Well, wouldn't you say that's TPD'd? So there's that fine line. So you probably get either one.
Now, because you mentioned that sort of homemaker sort of example, there is no real income protection for a stay-home partner, is there? So, but they contribute to the earning capacity of the other individual.
Yes, absolutely.
And I mean, if they're completely, there is no equivalent of income protection cover.
No, and you've got to work more than 20 hours a week, or minimum of 20 hours a week, generally speaking.
To qualify.
To qualify for income protection, depending on different provider. But there's a massive value in that. So if you did have a wife at home who's looking after the family, and you're lucky you could afford to do that, and look after the kids, and the wife, or it could be the other way around.
Yeah, or the husband. Yeah.
Where they fell quite ill and are in hospital for a couple of months and what have you, then obviously it's going to cost the earner or the breadwinner more to get that extra help, and their work could probably suffer too, because they have to take more time off work and deplete all their carers' leave, depending on their structure of their work and all those types of things. So yeah, it has a massive value. So that's why it started. It's why it was developed, is because of that, because there was no such thing, and there still isn't really.
Yeah, and there isn't such thing such as income protection for that stay-home partner.
That's the only thing really. I mean, you can get life cover, you can get TPD cover.
Yeah, you can get trauma
is the one that covers a lot more.
Yeah.
That will generally put you out of work or out of action for some period of time.
Yeah.
So it's a very good one, and it is expensive.
There's a gap in the system. Yeah.
Oh yeah, and it is. I will say it is expensive. It isn't expensive. My catchphrase has always been, it's better to have some than none of trauma, because. I don't know if I'm getting sidetracked here, but it's a very good point that I use. And again, when I recommend trauma for people, life cover is easy. You cover the debts and replace the deceased salary. That's pretty straight. It's pretty straightforward. TPD, again, you don't know what's going to happen, if anything. So you can sort of match that. It's not quite as,
and you can match it with income protection as well.
Yeah, and income protection can offset it. But again, coming back to the income protection, you can only insure up to 75 to 80% of your salary. All right. So you got to be able to, you can't just say insure for me for.
Yeah, absolutely.
But with trauma, Zurich, the insurance company Zurich, they provide a white paper, cost of care, or the cost of getting sick, or I think it's cost of care. And it's a really good white paper. It goes through and shows you all the different out-of-pocket costs for all the different particular industries and illnesses, I should say. And this would be very interesting for the medicos, showing the out-of-pocket costs after like private health insurance and all those types of things. So I come up with something, well, how do I know how much to recommend on that? I mean, it could be anything. Yeah. But then I've got to come up with the economies of scale of how much would be a good amount to have at what cost? Yeah. Because as I said, it costs more. So I focused on one of the big three, cancer. Yep. And I focused on a bout of out-of-pocket costs for a bout of chemo, obviously for someone surviving and what have you. It was about $150,000. So I've come up with a benchmark to say, for me, other advisors could have different benchmarks, but I've got good grounding as to establish as to why that's a good figure. And there's my evidence to say, well, that's not an excessive amount of cover. It's a very, very affordable amount of cover. And like I said, I picked one of the worst illnesses and try to match it with that. So again, that might be a tip from out there with someone too. They may have $600,000 of trauma, which they are oversold at, which we hate doing. If you got that amount of trauma, just go and have a look, see how much it's costing, and then just decide with yourself. This, mind you, this is not a recommendation. It's general advice. That's where I come up with the amount that I recommend, and that paper is freely available on the internet, so you can go up and look it up. So it's quite interesting. I just flick through it. I'm not even a medico, but I find it fascinating at the cost of care. Yeah. Out-of-pocket costs, I should say, after your health insurance and everything else. People think it, the medicos know this more than anyone, but that doesn't cover all the costs. No. It's a lot of gaps.
Yeah. I mean, there's lots of gaps in the public system.
Oh, absolutely.
We do have a great safety net, but it doesn't do everything it needs to do.
No, we do. Yeah. Well, we really, we are spoiled in this country.
Very spoiled.
We're pretty
absolutely. At least we're not getting people going bankrupt because of their illnesses. Unlike some other countries.
That's exactly right.
Yeah. Okay. So I think the general recommendation for anyone starting their career is to have this looked at, and obviously with time that will scale up. You may need a bit more of income protection. You may need some life insurance later on, just to cover all bases. But initially you may not need enough, but you can scale that up as you go along.
Yeah, but like you say, getting back to the someone's just graduated, just starting work. You've now have the ability to earn an income and increase that, of course. At least income protection, my opinion. It's my one of my catchphrases again. If you've got a job, you must have income protection. It's non-negotiable. It's like your car. Of course, you'll insure that. Yeah. So start out with income protection. So even if you've got no other assets or debts or what have you, but at least ensure your ability to earn money now and in the future.
Yeah. So, now our intern has done a couple of years. They've, luckily for them, they've met someone and they decide to get married. So that's our third D. You got to protect against divorce. But I think that's beyond the scope of this discussion.
Yeah.
They decide to buy a house.
Yes.
And obviously at this stage, you probably want to say you will need some life insurance once you get that property.
Well, again, it's a personal thing. You will need it. It's not a mandatory to get a loan, but you will need it if you want to protect your assets and your future. And now you've got to think, because if you become a couple and you insure, each person's got insurance, you're actually protecting the other person. So if the life cover that's on me is protecting my wife, and vice versa. So you got to start thinking like that. So you got to start thinking a little bit selfishly to say that, B, we got this X amount of debt, and your wife should say, have you got enough cover to cover that debt? Because if you get hit by that bus we've been talking about, I've got to pay that debt off. I need you to make sure. And you conversely, I don't know your personal situation, but you get the gist of how it works. So
it should go both ways, obviously.
It goes both ways. So and I often say that to clients, I say, you got to think selfishly now. Remember, the cover on that person's protecting you. And they go, oh yeah, I didn't sort of realize that. Because they'd say, I want cover. And I'm going, you want cover. Why?
Yeah.
Because if I die, I go, well, are you going to know you're going to care? They said, no. I said, it's actually protecting your
other
spouse.
Person. Yeah, your spouse.
And I go, that means you got to make sure
the spouse is also protecting you in return. Yeah.
So it's a very misunderstood and undervalued piece of advice, because people say you sell insurance. We don't sell insurance. It's just a tool that we use for risk management, as you guys use. It's a risk management tool, and you should have the right amount to cover those debts and calculated how much you will need. Again, I come up with the trauma levels. The other figures are pretty easy to work out.
Yeah, cover your debts.
Yeah.
As a very bare basic start.
Bare basic start.
You don't want to end up selling your family home.
No.
Where if one person dies, you got to have that adequately covered.
Absolutely. Yeah. So, and again, as we said, protect the other person. So again, as your debt may go up, when you've got the quality. Some insurance is better than nothing, but I'm talking about the more retail insurances that go up with your age. The cover goes up with inflation, and so does your premiums, what have you. And sometimes that can keep pace with as you take on more debt. Sometimes it can, because you will have to be underwritten again if you go higher, if you want more cover. So again, even if you say, I've got $1 million debt, and I plan on having, a $5 million debt, the insurance company won't just say, okay, here's $5 million. They'll question it. So it's a bit silly just to insure yourself for that when you might not take on that debt. So it's a give and take. So you want to take what you need now. And just like, for an example, with trauma insurance, my trauma insurance, I keep it at 150 for reasons I've explained. So that goes up with inflation over time. So the premiums, and it gets up to $300,000, it gets quite expensive. So then I go, nope, I tell insurance company, bring it back down to 150 for me, please. And my premium will come down relative as well. So there are ways you can control it. And that's why you need to review it too.
Yeah, you need to review it annually.
Absolutely.
Because there's the cost will eventually blow out if you let the inflation keep
like
going.
I see guys with, there are specifics. There can be exceptions when there's $1 million trauma and what have you, but we don't need to go down that. But that's very specific, like key man and things like that.
Yeah.
But we're just talking about the individual. But like I say, you really got to justify or be really clear on why you may need $600,000 of trauma or $500,000, because it's very expensive. And if there's a good reason, great. But if there's no specific reason, such as key man and other reasons, then like I said, it's better to have some than none. So don't say cancel it all.
Yeah.
Just potentially look at what reducing may cost, because I had angioplasty. I had 2 stents put in. And of course, I've been in the industry for many, many years. And I didn't even, of course, I got trauma cover, and I didn't even bother to see if I was covered. Because you know why? Because I didn't know the stent was called angioplasty.
Oh, right. Okay.
And I knew in the PDF, angioplasty, and then angioplasty. Hang on, isn't that the thing that I had too? It wasn't traumatic for me. It was in and out the same day.
Yeah.
And this was 12 months later.
Yeah.
Put in a claim.
Nice.
Not even a week later, it's paid.
Yeah.
Because I just got the medical report, put it in, and I was like, Oh, there's no time limit.
Oh, sweet, there's a cash.
Yep. Yeah. So yeah, it's like I said, it's better to have some than none. And that it was 50,000 that I got because they didn't pay the full amount because it was just angioplasty. These days, that's not really big a deal.
I think there's the max amount for certain conditions, and
Correct.
then with the lesser conditions, it's a fraction.
It's a percentage.
Yeah.
So it was 50. It was 25% of your cover, or $50,000, no more.
Yeah,
and I had 200 at the time.
Yeah,
so I got I think at 47,000. I got like, wow, that came in handy. But I was I was entitled to it.
Yeah, good.
So it's really worth understanding it. And sorry, I'm taking you off the rails here.
That's all right. And I think, once you get that insurance, you need to regularly review it.
Absolutely.
And we do have quite a number of members that they were sold a policy that just went on with indexation, and it just kept going and going without review. And the original person that sold them may have retired or moved on. And if you're in that situation, send an email to us. And
absolutely, like I've got a client. Yeah, absolutely. The client at the moment I've had for some time. He came with the book that I previously had purchased, I should say, and we're reviewing it now. And he's paying $70,000 in premiums.
Yeah,
he's not a doctor.
Wow,
he's not a doctor.
That's a lot.
He's not a doctor. He's just a manager of his own business. Which is not degrading anything, but the point is, he was saying, God, it's expensive. And I was saying, yes, it's really expensive. Man, what's going on here? And I called up the insurance company and found out he had 100% loading on his life cover and 50% on his trauma and TPD and everything like that. Wow. And I said to him, it was written in 2006, and I'd actually called the insurance company. I could log on. I couldn't find the details of why he had these loadings, so I called them up, and they're going to get it for me because it was written quite some time ago, 20 years ago.
Yeah.
And I said to him, "Has anything been wrong with you?" And of course, when you ask that question, everyone says no. But I really probed him, but he had a bit of weight. So I said, "It must have been BMI. Must have been." He said, "Oh," I said, "You look like you've lost some weight." But I hadn't known him that long. But he said, "Yeah, I've never had any cholesterol issues. Never had, all the typical things that they can load you with." And I'm now finding it, and potentially because his BMI is 33, I think he might be in the range to remove most of that. So that could save him nearly half of that 70,000 to keep the same amount. Admittedly, we need to adjust the covers, but for a start, you could have an opportunity to potentially remove all those loadings and just halve the amount that you're paying, which he'd been paying for years. So I just took him on. So he'd been paying for years. If you just let it go and don't look at it, it just can get away on you.
Yeah,
it can just run away.
I think that's happening to that's happened to a lot of people with the recent sort of increases, especially with the agreed value versus indemnified value. Yep. And I think in my own personal situation, I actually had to look at it. I'm actually earning a lot more than what my agreed value is. So it's like, there's really no point in having agreed value. Got rid of that to indemnified value because I'm at a stage where I'm earning steady income and I don't have to do a PhD and all these other things.
Yeah.
I think I saved about 30% or some 20 something percent or nearly 30%.
Can add
so I mean that's a really good saving.
Yeah. And there's lots of different ways you can structure it, because once you get me on this trade of insurance, I keep going. But there's lots of different ways you can structure it, tax effective ways you can do it. But look, I just feel it's just such an undervalued piece of advice, or because it's intangible, which is a shame. But when you actually see that you can, how it helps families and helps someone when they get a payment, that's ironically, it's so rewarding when I tell a client they're getting paid, but they had to get sick to get paid. It's quite ironic. I don't want them to get sick. I mean, you don't get the cover to be sick. You get it so in case you do, not because you want to. So it's not, and people think it's like an investment. Well, it is, because it's investing in your ability to earn income, but they've got the perception and think it's investment like on the stock market or property or things like that. But it's actually protecting that investment.
So, I think we've spoken a lot about that protection aspect. And so, at that stage where they might have a little bit of extra disposable income to invest in, they've got, maybe $100,000 each in their superannuation. Where does the sort of value of the financial advisor come in at sort of that stage of their life? I mean, they haven't really got too much investable assets. And I think that's sort of that gap where we see, it may not be enough for a financial advisor to come in and do a full plan, because really, if they're investing $1,000 a month there's really not that much room to play around with.
No.
So, but I mean, there's still value in understanding some basic concepts, and that's why
that's why they listen to podcasts. And
we have a podcast,
IFD website.
Yeah, and our other partner Jess, she's very good at teaching people about that general advice stage to sort of set you up for that future path. And
that's right.
But from your perspective, as do a lot of personalized advice, I mean, what would you like our listeners to understand, or 3 quick tips to set you up for the future where you may get to the stage where you need more fully fledged advice?
Yeah, that's a very good question, in the sense that I'll take one step back to lead back into that. Is the Royal Commission, after the Royal Commission in 2018 to the banking and finance system, 2018, there's all these recommendations made and what have you, but long and the short of it, they've tried to re-legislate the industry, or the way we provide advice, and remove a lot of red tape and make things more sensible, and to bring the costs down, so we could actually address that sort of person, to make advice more affordable to someone who's got $100,000 each and just a few bits and pieces, and don't have to be rich to get advice. Unfortunately, the government keeps stuffing it up, backwards and forwards, and it just drives you nuts. But anyway, getting back to that, so if someone's got like $100,000 each and what have you, and they've got some insurance and what have you in there, they don't understand quite what it means, or they may have some equity in their home and what have you. Things like Investing for Doctors Facebook group is a good start, obviously. And as you mentioned, our partner Jessica Brady, that's where you can get some good foundation education and take control of those basic things. It's like when I always refer to a doctor, it's like learning a bit of nutrition. So you learn a bit of nutrition to keep yourself relatively healthy and understand, but then if you get sick, you go to see a specialist, a GP or a specialist and what have you. So it's a bit the same. So you get the great basic foundation from books, seminars, Investing for Doctors group, and people like Jessica Brady who provide education on those basic concepts. So that's a good start. But sometimes, I'm more than happy to have a client, and I do, and a lot of listeners would know that I would give them an hour, a free consultation, an hour, and just talk through their situation. And I have said to some of them, look, there's really nothing I can do with you at the moment or help you, except give you a few pointers, like, they want to get hold of their cash, get more control of their cash flow and their spending and things like that. I mean, I can't tell them how to spend money, but you can learn better behaviors, and that's where Jessica comes in, spending behaviors and saving behaviors and all those types of things. So I still gave a few of them an hour and have a chat through it, and then I can sort of assess whether I can help, because the fees that we charge, I want to make sure that I'm actually adding a significant amount of value that's commensurate or actually exceeds the value of the fees.
Yeah.
So again, I get sort of a bit frustrated, but I always want to help someone. But again, we have these avenues, which is great, where we can point them to the direction of Jessica or the Facebook group. Well, generally they will come to us because of the Facebook group. But sometimes there are things you can do, but with the legislation and the licensing regime and the way we've got to provide advice, it's just too costly, and that's the frustrating part. Yeah. Even to recommend someone have one income protection policy, you still got to write them a statement of advice. There's a lot of hours involved in collecting the data information. Even though you can scope advice down, you've got to be very careful if you do that, and then write a statement of advice, and that could be 30, 40, 100 pages, and that's many, many hours of work. And you'll just if you keep doing that, you'll lose money. I mean, you got to pay the bills and keep the door open so you can provide advice. So it can be quite difficult. But what I would say, starting getting some education, even just ring an advisor and start a relationship, just talking to them. They'll give you an hour's time and get their newsletters and all those types of things. So you will pick up lots of tips and tricks as from the website as well. Yeah. But again, that's what I recommend. Yeah. Advisors like to talk, as you can see, and they like to actually help give tips and tricks to people and say, you can do this, you can't do that, you can do that. We've got to be very careful.
Or say you need to look at this, you need to look at that.
Yeah. Well, the rules are, the legislation states, or the rules are this and that and whatever. Gives some, But again, again, that's why I've had to come back to the Royal Commission and how the governments tried to, well, both sides have tried to, made a mess of trying to reform the industry, remove a lot of red tape so we could actually provide that advice far cheaper and open it up to most of the Australians, because most of Australia is unadvised. And so that's a real shame. But,
yeah, I mean, so we, there.
Oh, sorry. One thing I want to add with that, before all that, before the Royal Commission, what have you, there was the way the industry was sort of structured, and we spoke about this before, in such a way with the cowboys and what have you, but they're all gone. Well, there's probably one or two. There always is. The industry used to subsidise itself a little bit, and that would help us provide cheaper advice, because the industry, like platforms, would give the licensee some funds back, and insurance companies still do pay commissions, but only half of what they used to pay. So the government sort of shot themselves in the foot, by removing all these commissions and what have you. But on the good side is,
it's cleaner.
It's cleaner, and they want a fee for service, so you can see that what you're paying, you're getting some sort of service. But at the same time, now all the fees had to go up, because it's very expensive to run a practice, financial advice practice. But again, we're hoping one day they'll get to the point where we can make it cheaper, and we can provide it's quite simple, straightforward advice for just income protection with a few pages, rather than a 40, 50 page statement of advice and all the stuff that doesn't need to be in there. Well, I'm sure we'll eventually get there, but it'll take a while. So I don't know how to really answer that question, but except is, you got to get some self-education. Again, I like it back to me. I got to get educating why I had to get stents. Now I look after myself better. So, it's that type of thing.
Yeah. So I guess from like the junior doctor that doesn't have a whole lot of investable sort of cash flow or assets to manage.
Yes.
The simplest thing they could look at is, make sure your super is invested right. Make sure, you've got your insurances done right. Make sure you've got income protection, and, work out your cash flow yourself, because, there's so many calculators, so many spreadsheets on the internet to do that, to make sure that you can actually build up some spare capacity for investment in the future. Yeah. And to build those habits early on. So that at later stage, you have investable assets to play around with.
Absolutely. There are a lot of tools out there. This is not a recommendation, but there are, self-investment tools such as Raise, which is like a savings tool, which you can just invest in a portfolio and what have you. But just getting back to making sure you're investing in your super is invested in the right portfolio.
Yeah. Most young people should have it.
Yeah, a rule of thumb and common sense is obviously if you have more than, say, 10 years investable assets, well, you don't need to access for 10 years. With super, you can't till you're 60, so that's an easy measure. You should be in a high growth portfolio because you can't access the funds, and you don't need to use them for income because you can't. So you want it to compound and compound and compound and grow. So that's why if you've got more than 7 to 10 years, they say should be in a high growth portfolio. So young people, absolutely growth. And even up to your 40s. Growth, even more, but don't want to get too specific.
I mean, I would argue now that people are living so long that even when you're 60, you probably should have a big chunk in growth.
Absolutely.
Depending on how much you need to draw down in the next sort of 10 years. Yeah.
Well, my retiree clients, a lot of my retiree clients who their super's now in pension phase are still a balanced portfolio or a conservative, and a conservative portfolio is 50% growth and 50% defensive. That's half. And then some are in balance, which is a 70% growth and 30% defensive. So you need to outlive the ups. So you need to outlive your statistical life expectancy. And as the doctors would know about this type of thing, the life tables. A 65-year-old woman currently is expected to live 23 years.
Jeez,
And a man is 19 point something, so let's say 20 years. So if you retire at 65, you got that 20 years statistically. That's today. Statistically to live, and your investable asset, your retirement assets has got to last that 20 years. And don't forget you got inflation in there as well, which eats away the value of your assets. So you need to at least beat inflation and then potentially get a little bit more to make it last at least your life expectancy, depending how much you got. But you get the point. So you do need growth assets. Absolutely. So again, there are lots of things on there's a lot of material on the internet just by looking at the product providers' websites, because it's not full of rubbish. They've actually got some good statistics and facts there, which are ABS from the ABS and historical facts and what have you. So look at those sort of websites and you can get the idea. And like I said, I often see in investing for doctors, people investing in ETFs, which is exchange traded funds, which is like on VAS, which is Vanguard Australian.
Yeah.
I mean, that's all great. They're getting that's not like
that's growth. At least that's growth.
That's growth. So they understand that. So yeah, there's a lot of stuff out there. And like I said, when it comes to the IFD group, plus Jessica Brady's trading program and what have you, I think they're good on books and seminars, as we've got this one this Saturday. Is a good place to start. But again, as I said, with getting back to the value of advisors can provide in the risk insurance side of things is, even if you at least get your income protections, we can sort of like help you with that a little bit. I mean, they can get commissions over there. Some will do a bit of pro bono. You might get a bit of a you get commission on that, and it's sometimes you take the risk and go, look, I just want to help you out, get an income protection. I won't charge you. If I get commission, great. Generally you can do that. You can do that every now and again. I do that, and I like to do that to help people. But the value comes later in life, as I think we're going to go up that road.
Yeah, and I think once say individual finishes their training, they've they got their own home, they're starting to look into investments, whether that's property, stocks, or some even higher risk options than that. That's when the value of a financial advisor really comes in, isn't it?
Yeah, the true value can come later in life when it comes to structuring, because really structuring is pretty much one of the most important things of who owns what assets. And that's what I mean by structuring. So should I have an investment property in our name, my name, trust, super fund, same with shares and all those types of things, or maybe my insurances, how should they be structured? Should I have them in my name? Should I have them in my super fund or what have you? So it gets, and then when you've got kids, you want to put them. A lot of doctors are specialists, are high income earners, and they want to put money away for their children. They're going to get potentially taxed on that earnings. There are ways to quarantine that. So it's all about the structure, so it can go into another structure. So that's where the real value is, I believe, is added. Plus the education you get around how do these different structures work, and the tax incentives and just different sort of rules and regulations around the different structures. So that's where it really starts to really, really show its value. And even sometimes, as simple as just setting someone up properly with a, account-based pension and what have you. You can put them in zero tax environment. You could save them, $10,000, $20,000 a year in tax, just by simply doing some simple things. So that's where the real value goes. But that can start. I mean, that can start at 40. I mean, it depends where you are. Where you are, but what assets you have or resources, I like to say, that you have available to you at that point in time in life. Because everyone's different.
Everyone's different. And, I think looking at a doctor's life trajectory and career trajectory, you're talking probably about the mid-30s where
start to really hit their straps.
That value really starts to come in. Whereas I think before that, you're much better off just, DIY, learning it a bit and making sure you've got yourself set up to protect your earning capacity, and all that sort of thing.
I mean, with the DIY, it's you could call it DIY, but it's DIY with some assistance in such of gathering some information. Like the Facebook group and other things. And
like you can just automate some easy to understand things. Sort of the I call it the gateway to understanding investments. And usually someone will have a property, someone will have a bit of a share portfolio, and then in the majority of the time in their own names. And so again, that's the value. I mean, a lot of clients have come to us from the IFD Facebook group. They're all earning extraordinary amounts of money, and they've got assets in their name. Depending what the asset is, sometimes that's right, sometimes it's not quite right. But then we look at strategies to debt recycling, which a lot of people would have heard of, which can actually help reduce your tax. But then isn't it worth paying someone whatever it costs to save you 10 times of what they're costing you? It's I think that's a no-brainer.
It's a no-brainer, but. So that's where the real value, I believe, adds. I could go on with many examples, but you're right. It's about then when they start to hit their straps, because I've seen a lot of young people, young doctors or members in their 30s, $1 million each, a couple. I'm like, I'm in the wrong job.
Yeah, well, but I think they're also holding in the wrong structures as well. So,
Well, yeah.
which
but
can
then
be vastly improved.
but then you guys are really, really stuck with the personal services income.
Yeah,
That's sort of like a real thorn in the side, that one for us,
Yeah.
because there's only a certain amount of things you can do with that.
yeah,
But there are things you can do.
yeah. I think we're running out of time for this episode, so we will continue talking about our doctor as they get a bit further in their career. And
Okay.
so I guess to summarize, the value of the financial advisor starts when you start earning your first paycheck.
Yes.
And the majority of the time that's basically having your insurance set up right, usually income protection. And once you hit to the stage where you start to have some
Investable assets,
or a home or
Yep.
investment property, that's where you need to make sure that's covered. If you have a partner, you got to make sure that they're covered, and vice versa, and they're covering you as well. And once you get children, obviously that you just have
Well, that's laying the foundation for a start.
Exactly.
Yep.
So you get that foundation set up right. You make sure you have your super sort of invested right. Make sure you're heading the right direction in your career, and making sure you start having some really good habits. And whether that's through just regular contact with a financial advisor who sold you the insurance policies, because you can often sort of get some education through that process.
They actually, so just quickly finish on that. The insurance companies do provide trail commissions, which is so you can talk to so you have a right to talk to them and ask them a few questions. You can ring up the product provider, but call the advisor who sold you the product, and as well as to help you assist you with the claim if you need to make a claim. Yeah. So there is trail. So you're entitled to talk to the advisor.
Yeah, absolutely. So you should talk to them.
Absolutely.
And perhaps, they'll offer you some additional help and assistance along the way. It doesn't hurt.
Yes. I know we're running out of time, but just finishing on that, as I said, they pay a trail commission. If we come across a client and they've got insurances in place, the easiest thing for us to do is to sign. If they don't have a relationship with an advisor, we often send them back. If they don't have a relationship, we say, well, we can assign it to our licensee via us, which you will start getting the trails, and then we can start reviewing it for you and servicing it for you, see if we can do something better. And that's where it can sort of self-fund itself. That's where it can sort of happen as well, which is great. Because then we could say, no, it's all great for what you've got's good, or I think we need to change this in here, and then you've just become on board as a client.
Yeah.
So that's open to the IFD members.
Yeah, absolutely. Yeah. So I think that's always worth having a review. So if for the listeners out there, you haven't spoken with the person that sold you the policy, feel free to jump on board with us.
Yeah, that's a program we will be talking about down the track. Yeah.
Yeah. Awesome. So thank you, Roger. And we'll continue this in our next episode. This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.